Your money is being stolen right now, this very second as you're watching this video. It's been happening your entire life, and this thief has become more determined in the last 2 years. The police allow it, banks help it, and those in power even want it to happen. It's stolen over 10% of your income, savings, and retirement in just the last year without you even noticing. This thief is called inflation, and it's one of the biggest threats you have to your wealth. But inflation doesn't steal from everyone equally. In fact, for some people, inflation helps make them rich in comparison. Over the past few years, billionaires have seen their wealth collectively double, while the average person's wealth has declined. To make it worse, the cost of living has increased to eye-watering levels. So not only are people poorer, but they can no longer afford what they used to be able to. But how does inflation steal from you without actually taking a single dollar from your bank account? What really causes it, and why are some people even in favor of it happening? And how do you keep this thief, inflation, out of your pockets and trick it into working for you? It's actually surprisingly easy if you understand how it works, and I'll explain this later in the video. What is inflation, and how does it steal from you? Believe it or not, inflation in moderation can be a useful tool for the economy. This at least is what central banks, the government, and economists tell themselves. In reality, it's more of a band-aid solution to a lack of growth. You see, inflation in general indicates an economy that is growing, where deflation, as the word suggests, means a shrinking economy. This is a big problem for governments, and they'll basically do anything they can, even start wars, to avoid deflation. As prices, wages, and the amount of money in an economy rises, the assumption is that people earning more money, buying more stuff, are typically richer. This is actually true, but if only it were this simple. In the real world, nothing is ever perfectly balanced or fair. And if one thing is for certain, the balance of wealth between the top 10% and the bottom 90% has been anything but fair recently. And inflation has played an enormous role in that. How, you ask? Well, first, I'll quickly show you a relatable example of inflation in action. Then we can get into the murky details of how it steals from the poor and enriches the already rich, and why this benefits the government you vote for. Let's say you make $600 a week, and a loaf of bread costs $6. That's some pretty expensive ass bread with 1% of your weekly income, but you haven't seen anything yet. If we had 10% inflation every year and your income didn't rise with it, after just 25 years, that one loaf of bread would be worth over 10% of your entire income. The relative cost has gone up by over 10 times due to your money being worth 10 times less. Now, this is obviously a bit of an extreme example because income usually comes close to keeping up with inflation, but that's unfortunately not what's happening currently. The average salary increased by 4.5% over the last 12 months. That sounds pretty good and would usually be good, but when you compare that to the 10% inflation, in reality, your pay has actually been cut by over 6%. That means for the same amount of work as last year, that money buys you less, even with that increase in pay rise. You are in fact poorer. Inflation has effectively stolen that income from you, and you've happily accepted it, maybe even put in more work to earn it. This is how inflation quietly steals from you. While you smile and appreciate the increased income, inflation doesn't only affect us in the obvious way, which may not have been obvious before, but after hearing this, now it should be. If you've been contributing to your retirement for most of your working life, inflation has stolen 10% of that as well. Essentially, any cash that you have on hand over time loses value. But inflation isn't all that bad. In fact, we do need some inflation to keep the economy growing and moving. A positive inflation rate that isn't too high allows for salary increases, charging interest on loans, and paying that interest back. Central banks and governments use interest rates as a tool, and in some cases a rudimentary blunt force trauma-causing weapon, in an attempt to influence overall inflation. By raising rates, they make debt more expensive, lowering market-wide credit utilization and spending related to that. Alternatively, they can lower rates, making debt cheaper and enticing additional spending with credit. Most of the time, these moves are incredibly risky and often have caused the bubbles and the crashes that we've seen in the past. Inflation is also notoriously difficult to reduce once it gets some momentum, which is exactly where we're at right now. Because inflation is a fundamental element of the economy, it acts with a multiplier effect. To put it simply, there's no one source of inflation, and it's not just the case of Jerome turning on the money printer and boom, your morning coffee has doubled in price. Although with some recent increases, like how 7-Eleven doubled the cost of its coffee from $1 to $2, it can seem that way. I've noticed plenty of things increasing in price around me as well. In reality, there's a few different ways inflation creeps into your wallet. Most are bad, but some of them can be beneficial, at least to the economy as a whole. The most well-known, and to be honest, most notorious sources of inflation is money printing, or how it's officially called quantitative easing, and even recently, stimulus. This covers a broad category of actions governments take with a specific outcome in mind. The most recent example of this was the range of actions taken during the pandemic to either help people and businesses stay solvent or to encourage spending and mitigate the risk of a sharp recession due to a flatlining economy. I'm sure you all remember receiving your stimulus checks, or if you were a business owner, getting those sweet, no obligation relief loans with a very favorable and even non-existent repayment clause. This is money being created out of thin air that the government was throwing at people, hoping that it would keep their businesses afloat. And it did work. People rushed out to buy stuff with their new money, whether you were the kind of person to go out and buy a new MacBook so you could watch Netflix during lockdown, or you got a Peloton bicycle to get in shape since you had nothing else to do. Keep these two companies' names in mind though, because we'll come back to them in a minute. Maybe you were even one of the thousands of people who immediately put this extra money to work in the stock and crypto markets, causing them to rally to new insane highs. Another type of inflation is one that's plagued the global markets recently, and it's called cost push inflation. This is where basic material and production costs to businesses rise, and to stay profitable, they raise prices for their customers. We've seen this recently with all the supply chain disruption globally, where the price of many materials like lumber, wheat, and computer chips have skyrocketed due to manufacturing shutdowns. With businesses competing for limited supply and shipping costs rising, many industries have no choice but to hike the price of the finished goods. Makes sense, right? Even something as small as a $10 computer chip was causing massive manufacturing bottlenecks across industries. These chips were needed for GPUs, electric car window switches, and even toys. A single missing $10 chip meant that an entire $80,000 Tesla couldn't be finished. This leads us into the last type of inflation, which is called demand inflation. This one is pretty straightforward, and in essence, the most basic type of inflation there is. The more demand beats out supply, the higher the price of products. Look, you live in the desert, and every week some dude comes through town and brings water for you and your family to buy. The water usually lasts a couple weeks. If a different guy comes through town next week and has more expensive water, you can say, no thank you, and wait another week because you still have some water left that will last you until the original guy comes back around again. This is somewhat of a balanced supply and demand. But what if your town already has its own clean water supply, enough to last years? If someone comes through town selling water, he won't be able to sell much at all. This is where you see an oversupply and in turn a lack of demand, so prices drop. Now, on the contrary, imagine the entire town is out of water and the guy selling only has a single bottle for sale. You're going to pay any price he asks. Its value is infinite. This, of course, is another extreme example, but can be applied to any industry and product you use, although chances are you don't live in a desert and you won't have to trade everything you own for a bottle of water. But what if a bottle of water really did cost everything you own? And how much inflation is too much? Most governments aim for about 2%, but is 4% high? What about 10% or 20%? At what point does inflation become unsustainably high or even out of control? Fortunately for us, and unfortunately for those affected in the past, history has a few examples of hyperinflation. Officially, it takes an inflation rate above 50% to become hyper, but as high as that sounds, historically, that's nothing. The most famous example of hyperinflation happened in Germany in the 20s. Imagine buying a loaf of bread in 1922 for $4, and 1 year later, it costs $5 billion. If you were a billionaire at the start of the year, by the end of the year, you won't even be able to feed yourself. The worst part is that this was done deliberately by the government. That is real theft, and shows what can happen in extreme cases and how much power a government really has to take your wealth away from you if they decide to. And that's one of the reasons why I'm personally such a proponent for crypto, because of its non-custodial and decentralized nature. But why would a government do that? Did they just hate the idea of their own population being able to survive? Well, not exactly. The reason Germany devalued their currency so much was in a desperate attempt to repay war debts to allies. They didn't have the economic capacity to repay them, so instead they chose to print as much money as they could, trading it for foreign currency to repay it, at the expense of their own population's income and savings. It worked for a while, but you can only outrun consequences for so long, and eventually the printing caught up with them, decimating the economy. Other countries also realized what they were up to and refused to accept their currency, instead demanding repayment in raw materials like coal. While this was all happening, Germany continued to pay its own citizens in worthless paper, which led to strikes and civil unrest. Surprisingly, hyperinflation has taken place more than 50 times throughout history, and even recently as 2016 in Venezuela. It got so bad that seeing children catching rats for food was common in the streets. Mind-blowing to think about in the modern world that we're living in. Now, while the minimum wage in Venezuela has risen to an astronomical level, the real value has dropped from $360 per month in 2014 to less than $2 a month this year, and overall inflation increasing over 53 million% since 2016. Arbitrarily declaring raises in minimum wage doesn't benefit anyone. They're just numbers at this point. So who actually benefits from inflation? I mentioned earlier government love short, low spikes in inflation as it tends to temporarily boost growth. That boost in growth usually pays for itself in additional tax revenue and economic strength to mitigate the side effects. But like anything addictive, the more you use it, the less effective it becomes, and the harsher the side effects are. Now, surprisingly, the group of people who benefit from inflation is any government, company, or person with a lot of debt. Just like the Weimar Republic devalued its currency in an attempt to pay off its war debts, anyone with outstanding loans benefits from the value of their loan being reduced as the value of their currency declines. If you bought a house today for $500,000 and tomorrow the dollar drops 99%, your debt would still be $500K, but your property would likely be valued at $50 million. Your income in the new cheap dollars would likely be able to pay off your $500K debt in a few months, and now you have a house fully paid off. This applies to any asset denominated in a currency. As long as nothing is done to reduce inflation, asset prices simply keep rising. And this is where we find our main beneficiaries of inflation, those who own a lot of assets, and especially those that finance those assets with long-term, cheap debt. Yep, millionaires and billionaires. The sector of society that has mysteriously gained so much wealth in the past couple of years. The ones who own companies which have seen valuations skyrocket and have been able to refinance long-term debt at record low interest rates. Remember earlier when I mentioned Netflix and Peloton? Well, those two companies gained massively during the crisis for slightly different yet related reasons. Both companies clearly benefited from people being stuck at home, and both companies saw meteoric rises in their stock prices during this period. Peloton directly profited from the stimulus checks because their bikes retailed for around $2,000, and thousands of people conveniently used their stimulus to buy one. Netflix doesn't have any high-ticket products like this, but it's widely accepted that people who would have otherwise cancelled their subscription didn't due to the availability of stimulus. And now both of these companies have since seen massive fall-offs in revenue and subscribers after the stimulus and lockdowns ended. Well, I just mentioned millionaires and billionaires already have this one figured out. The not-so-secret answer is in assets. While inflation erodes the purchasing power of everyday people, assets benefit from rising inflation to an incredibly disproportionate degree. You see, not only does their value rise as there's more money available fighting for the same number of assets, but people know this and actively look to invest in them to avoid holding too much cash. This pushes prices up further, far beyond what the headline inflation rate would be. Real estate is the obvious asset to have inflated heavily over the last few years, with some stories about people bidding far above asking prices just to get their hands on the limited supply. Record low interest rates, the availability of stimulus, and low supply have all contributed to insane year-over-year growth. Some areas even seeing as much as 20% growth. This is more than double the current US inflation rate of 8.3%. However, if you don't already own a home, inflation has made that dream much harder to achieve and completely out of reach for most people. Stocks have also benefited from inflation, experiencing one of the most impressive rallies in history. You could have chosen any random stock after March 2020 and seen massive gains over the past 2 years. This was almost entirely the result of record low interest rates allowing companies to borrow their way to growth, alongside being showered in cash from speculators anticipating inflation and growth. This rally also coincided with the start of the crypto bull market in the same month for the same reason. An excess of capital flooding the markets, looking to buy up any asset at any cost. However, markets always lead indicators in the economy, and both the stock market, crypto, and housing markets have seen massive declines as interest rates have been raised in an effort to curb inflation, which has stayed annoyingly high, as you know. Precious metals like gold and silver have always been seen as a safe haven against inflation and general market uncertainty, but have remained surprisingly flat despite a high inflationary environment. They did see a rise from early to mid-2020, but this was mostly fueled by uncertainty and fear. At this point, only a few people were expecting high inflation and were more worried about not having stockpiled enough toilet paper. I'm sure you remember that insanity. No, instead of ballooning in value, like a lot of people expected once cheap money started flooding the markets, they actually showed weakness. Rate rises have further hit the value of precious metals, as rate hikes are inherently deflationary. I think there are too many factors at play right now, both for and against inflationary pressures, for a clear call on whether holding precious metals would be better than cash or stocks. Usually I'd say yes, and I want to say yes, but we've been seeing some extraordinarily unique markets these past few years, so be cautious. I'm not going to throw everything I have into shiny coins anytime soon, anticipating hyperinflation, but I do think a long-term small holding of gold or silver is a nice bit of security to have. Though I do see it holding in a similar way to bonds, where you're never really going to make any money, but it's always nice to have a fallback that tends to not lose as much value at least. However, if I were living in an unstable country with a high risk of financial collapse, precious metals would be one of the best places to put your wealth, aside from crypto. Now, crypto is an interesting one and has for a long time been touted as a better version of gold, right? While also providing the potential for insane growth in capital. This was always the downfall of gold as a hedge, because those who don't like precious metals say it doesn't produce anything. And to be honest, they're not wrong. As Warren Buffett once said, a big block of gold would be nice to look at, but it won't do much but sit there looking pretty. Crypto and NFTs, on the other hand, have shown to be excellent markets for growth, or at least did until the current crash. And this is where the weakness in crypto as a hedge against inflation comes into play. Of course, if the dollar loses 99% of its value tomorrow, Bitcoin will likely skyrocket, as it would still hold fundamental value in global markets. This is a direct hedge against one type of inflation. However, when we're talking about single-digit inflation rates, these are small variables compared to how crypto is actually perceived in value, such as supply, security, ease of access, and potentially the most important factor, speculation of future increases in value. If you ask me whether I'd prefer $100,000 or one Bitcoin in 20 years, I would choose Bitcoin, no question. This is almost a guarantee based on long-term inflation, but year to year, who knows? What's more impactful is where project regulation and sentiment is headed. So yes, I would personally always have a chunk of my portfolio in crypto for many reasons, one of which is as an ultimate hedge against currency collapse, but there are much more stable hedges against year-to-year inflation, and that's what we're facing today. There'll only ever be 21 million Bitcoin in existence, while the inflation of the dollar is theoretically infinite. I know which one I'd prefer to hold long-term, but are there better ways to protect yourself from inflation in the short term? Absolutely. If you're working paycheck to paycheck, it's one of those things that's going to be hard to avoid no matter what you do. Assuming you have no major assets, no real cash savings, or any other form of wealth, one high-risk strategy that very few people take advantage of is the power of inflation to devalue debt. Now, I'm not saying go out and laden yourself with credit card debt, but if I was sure that inflation were to remain high for a few years, I'd try to lock in a fixed interest rate as low as possible on a long-term loan, ensuring low monthly payments I can easily afford. As I said earlier, inflation erodes the value of debt over time, essentially giving you valuable money at the start and allowing you to pay it off with far cheaper money later on. This money can be used to invest in long-term inflation hedges or to build a business with low input costs that is positioned to do well in an inflationary environment. Keep in mind, governments will actively try to reduce inflation, if they're actually sane, by raising interest rates and taking other deflationary measures. This often causes recessions and reductions in overall inflation. On the other hand, if you have a lot of assets, income, and cash, protecting yourself from inflation becomes fairly simple and risk-free. I'd have a mixed portfolio of precious metals, crypto, inflation-positive stocks, land and real estate, and TIPS, or Treasury inflation-protected securities. TIPS increase with inflation and decrease with deflation. I'd definitely even throw in some fine art there if you could afford it. Under no circumstances would I hold more than 10% of a cash position, or I'd risk that thief eroding it. Any cash I would need would come from credit or loans. Basically, do as the rich do and own assets and keep an eye on the rate of inflation for signs of an inversion to a deflationary environment. With that being said, you should be able to protect yourself from the thief of inflation regardless of your situation. I've taken some of these steps myself while watching the markets closely. The more information you have about why things happen and how they affect you, the better prepared you are for the future. Now that you know how to protect yourself from inflation, what do you do during a recession that follows it? Watch this video to find out how to get rich during a recession that we're entering right now. If you made it all the way to the end of the video, please comment down below. Inflation is a thief. As always, I shall see you in the next video. Cheers.